Oh, we don't want that to do that. We'll just get into it. There we go. All right. How you doing, friends? This is the 0DTE Final Hour Show, episode number 5. And just so you know, this is being simulcast on YouTube, X, LinkedIn, Facebook, and also it will be shown on Apple Podcasts and Spotify, and I think a couple of other places. Everywhere. We're everywhere. But I really appreciate you showing up here. And today we're going to talk about what goes on in the very first hour of trading for a 0DTE trader, particularly one who's trading convexity like we are. What that means is huge asymmetric risk and butterflies, and trying to take advantage of both directionality as well as optionality. But let me just tell you, when the opening bell rings, and in 60 minutes, the market will throw everything at you. Fake breakouts, speed traps, volatility spikes, and just enough momentum to make you think you have to act. Now, the first hour of 0DTE trading is where conviction meets chaos. It's the most dangerous and most misunderstood window of the day. But if you know where to look, it's also where you can catch the cleanest convex setups before the crowd even realizes what happened. So in this episode, we're going to break down exactly how to navigate that first 60 minutes without getting sucked into the noise. You'll see why the first hour is less about prediction and more about posture. How the market's opening structure, overnight gaps, and the volume profile clues set the tone for the rest of the day. So we'll map the pre-bell preparation that puts you ahead before the open, and then the early entry criteria that separates high odds setups from adrenaline trades, and the psychology behind knowing when not to pull the trigger. All right. So the first hour is where 0DTE traders can capture the sharpest edges of the day. Volatility is concentrated here. And of course, there is another volatility concentration at the end of the day at 3 o'clock, and that's going to be a separate show. But making reversals off of structural levels is far more likely in that volatility soup in the morning. And it's the window where you're most likely to catch the session's true high or low before the market settles into its rhythm. Now, the goal isn't to predict the move. It's to position where structure and volatility intersect, and then act when the market blinks first. So in this episode, we're going to cover why volatility and structure make the first hour a prime hunting ground for reversals. We'll also look at how pre-market mapping sets up the best reaction zones before the bell. That's super important. Also we'll look at the early entry checklist that filters noise from opportunity, and finally when to stand aside and let the first hour reveal its posture before committing capital. All right. So first of all, I want to cover the point of where positioning, we're not trying to predict. And I used to be a big proponent of trying to figure out which way the market's going and then settle in that direction. And for one of our 0DTE trades, we are directionally motivated, but still we really don't know which way the market's going to go. So we trade with the trend. And if you know anything about the trend, you'll know that even if there's a bullish trend, half the days are going to be bullish, half of them are going to be bearish. It's just that the ones that are in the direction of the trend tend to be of greater magnitude than the ones that go counter trend. So even in a trending market, it's kind of up in the air. It's a 50-50 shot if you're going to try to guess which way it's going to go that day. Now, you can get a little bit tricky and wait to see how the market's going to commit. Maybe use an opening range breakout strategy, something like that. But even that doesn't guarantee that it's going to end up, in the direction of that breakout. So the most important thing is that timing and what we want to do. So there are two things. There are a number of things that we want to make sure are all in our favor. Again, we're not trying to predict. We're trying to position. So that means that in general, if we believe there's a bullish trend, we're going to put a position above the market. If we believe there's a bearish trend, we're going to place it below the market. Now we can change our mind when the bell rings, but you don't want to jump the gun too soon because you really don't know what's going to happen. But why does volatility and structure make that first hour a prime hunting ground for reversals? Now, first of all, that's essentially what we're looking for. We want to find what we believe will be the low of the day or the high of the day. And in that first hour, we have a lot of volatility. Markets going all over the place. But where do we take the trade? So that's what we're going to cover here and why volatility will help us out. The open is when overnight positioning, pre-market news, and pent-up order flow all hit at once. That surge of volume can push price into key structural levels faster than at any other time of the day. So it's the energy that's in the market that's pushing it up and down in the beginning that will ultimately bring it to a structural level where there is natural support or resistance. So that tells us that, that's what we want to look for. We want to look for that indication where it hits support or resistance, and then that's where we're going to take our trade in the direction that we want to go. So if you've mapped those levels ahead of time, you're ready to fade the exhaustion and catch the first clean reversal before the market calms down. Now, what does it mean to map out these levels? So that's what we're going to cover next. How pre-market mapping sets up the best reaction zones before the bell. And we'll go to the charts for this one. So, and I'll also do a much more in-depth show later on where we talk in great detail how we look at volume profile. And that's really what I'm talking about. I'm talking about market structure. And the structure of the market is where there are likely to be traders hanging out either and fighting over levels. And then you have to determine, what levels are they fighting over? They're fighting over the levels that are important to them, the ones that they've demonstrated where support is or where value is. And then there's the lack of support or fighting over. There are areas where there's heavy-duty fighting, and that creates a sea of volume and trades at certain levels. We have to figure where those are. And that's what volume profile comes in. And then there are other areas where it seems traders don't want to go. And then there is particular levels where nobody wants to go. It's like, for whatever reason, it's forbidden to go on 65.25. Who knows? I'm just making that up, right? So success in that first hour starts hours earlier. Actually, I would say, depending on whether or not we're at all-time highs or not, I might be doing this structural analysis maybe once a week and then update it every so often when necessary. But when you're at all-time highs like we are now, there's very, very little volume to make a mature profile. So you have to update it a little bit more often than most. So let's go to the volume profile. And we'll take a look at that. Oh. Does undo work? Oh, good. Thanks. I just deleted the volume profile and it went away. And I was worried that it was just going to, I would have to go set it up again. And I'm just going to make it a little bit brighter so it's easier to see. All right, there you go. I know you can't see it yet, so give me a second. Wouldn't you much rather look at my face than look at me setting up the volume profile? I'm sure you would. So we'll go to the volume profile now. That's not it. Trading view. So first thing I'm going to do is I'm going to back out a little bit so I can see more of the profile and take away these lines so that you know exactly what we're looking at here. All right. So here's our volume profile. What is volume profile, first of all? Volume profile is volume at levels, where the type of volume you're normally looking at down at the bottom is volume at specific time slices. So that volume will tell you how much volume happened between this minute and that minute. This volume is telling you specifically where the volume is at specific levels. How many trades have occurred at that level? That is way, way more important than the other volume. I'm not saying that volume at time intervals isn't important. It's just that most pro traders understand that time is kind of elusive in a market. The market works on its own time frame, not on your time frame. But what it doesn't work on, what it doesn't have any discretion about, is where value is found, and that's at the levels. And that's what's so important here. And so in a volume profile, we have these nodes that are showing a preponderance of trades happened at these levels. So for instance, this node up here at the top is at about 64.16, and at its bottom is between about 6400, right? So that means there's 15 points of range in here that the market has gone over and over and over. Every time it comes there, it says, hey, I like this level. Let's hang out here. And so what you'll see is a lot of consolidation in that area and high conviction. And every time you go there, that's what happens, whether it's here or a little later on here or a little later on over here. And then there's the lack of volume. That would be in between these nodes. So the big node here, we call those HVNs, high volume nodes. And these this lack of volume, or kind of like an anti-node, is called an LVN. All right. Now, for someone like us traders, our decision points are on the intersection or the edges of HVNs and LVNs. All right. This is where the market is likely to test. The market and traders are setting up on either side of this. This is where the battle is. That's why these nodes are there in the first place. They've set up the battles above and below these areas, and there are some people that want it to be there and other people that don't. Now, what this creates are gamma walls and support and resistance levels. In fact, I'm sure that you've found all different ways of discovering market structure by drawing lines and trends and moving averages. None of that matters. In fact, they're all just derivatives of this. This is where actual support and resistance resides. It also will tell you where markets are likely, or how markets are likely to behave. Now, you know that markets tend to either trend or consolidate. When they're trending in areas where the market and market makers and institutional traders can easily move the market, and that's where there isn't a lot of liquidity. Well, where do you think there isn't a lot of liquidity? Well, those are areas, the black areas here, or where volume nodes aren't. So markets tend to trend like this, trend here in these low liquidity areas, and then consolidate in these high liquidity areas. So now you've got two very important features. You have behavioral characteristics in terms of trending or consolidating, and you have support and resistance characteristics, and also the boundary between those. So you can see where breakouts are happening. You can see where ranges are likely to form. You can see where things are likely to consolidate or move to, or where price is likely to go when it leaves one volume node and enters a low volume area, which I call a volume well, a low liquidity area, searching for value somewhere else to another volume area. This is all super important, and what we do is we mark up these nodes in such a way that when we zoom in, we can see that markup, and then we know exactly where the most likely places are that price is going to find support and resistance, and how it's likely to behave as it crosses those various areas. This is super, super important, all right? So we're going to put the lines back here, and you can see that I've marked them up with different colors. The colors help me identify where nodes are and where these volume wells are. And also these deep crevices are very important as well. So that when I zoom in, say, to a 5-minute chart, so that's the time frame I would normally do trading in, I can see where they all are. Now here's one that I have marked up, even pretty much the same thing. And what you'll notice is that price is respecting these lines, right? And so that's what I'm looking for. Now, how does that chide in with our using morning hours and volatility? Well, the first thing I do is I want to know, well, where's the morning hour in this 5-minute chart? So I map it out with these vertical lines. Now, we consider the morning session actually beyond just that first hour, but the first hour is where most of the trades are happening, right in here. But for us, the day is split up into 3 segments, the morning or sessions, the morning session, the afternoon session, and the closing session. So this is the morning session from 9:30 to 12:30, and that's the longest session. And then the next session is the afternoon session from 12:30 to 2:30, right here. And then the next session after that is what we call the closing session, and that's right up until 4 o'clock, right there, right? So those are the 3 sessions within the day. The morning session is where we're looking to enter a trade. So this is all part of our preparation. It keeps you focused on high probability reaction zones instead of chasing whatever candle just printed. All right. So I'll give you a good example of all this. So here's a very good example. Here's a case where we're inside of a node. I can tell that because a green line means the bottom of a node. A red line is the top of the node. So the top of this other node is way up here. And the market opens. It has some churn, and then it breaks through this node, this node's bottom of the node. That's significant because now it's entering into a low volume area or a low volume node, an LVN. And it's going to move fast, and it's moving fast, right? So that would be a key area where we might want to take a trade as an example. And this line here that I have kind of thick is actually sitting on top of a very influential level that if you go and analyze the volume profile, you'll see that there's a small node right there that has been touched many, many times in the past. And that's also another breakthrough area. So we see it come up, find resistance on this node, try to bounce into this node, pull back, and then finally break through. Right? Once it breaks through, then on the bottom side it finds that as resistance. From the top, it's support, and then continues to move down. Now this is the bottom of a node right here. This red line. Oh, I'm sorry, this is the top of another node. So it's moved down very sharply through the volume well. It dips briefly into this node, right into one of its main crevices. That's right here. Now you can't see that yet, but we'll zoom out to show you. Let's see, this level right here, or this node right here is at 63.48. So let's go to 63.48. Down here. That's the top of this node right here. So it's hard to see, but because we don't have all of the volume, but I'll bring it in. So I have it as marked at 63.50, but it's, you know, within a point or so. It's right there. All right. Let's see. Too much going on here. So we use these nodes during that first hour when volatility is at its peak. We know that it's going to be moving and it's going to be reacting to these levels. And so we have a number of different ways that we can look at it. We can look at breakouts or, you know, breakdowns into a node, out of a node. We can look at reversals. So let me see if I can find a good example of a reversal right here. So here we come into the new day, and right out of the gate, it bounces off this node, but I'm not so sure. It's kind of tough on the first 5 minutes to make a decision here whether or not that's true or not. But we have a bullish bias this day, and so it comes back down to the bottom of this node right here, which is a strong support area. And when it hits there, that's when we'll put an out-of-the-money fly. And that's what this box up here represents. And so now we're in a trade. This is the trade. And we're waiting for price to come in our direction, because the theory is that it's going to bounce off the node and then reverse off the node and continue up in our direction. So this allows us sort of an early entry. And so we want to have like a checklist that filters noise from opportunity. So not every fast move at the open is worth trading. And case in point here, I'm not so sure what's happening here, because it came down, bam, and then up fast. So not quite sure yet, especially when we're sitting at the bottom of a volume node. So I look for hesitation at a mapped level, signs of structural defense, and a reaction confirmed by market internals before entering. And so we're monitoring exactly what the market's doing here. It pulls back a second time. And also we have this indicator down here that tells us when there's likely a divergence developing. And so we're seeing that divergences are building up right in this area. So that gives us more confidence that this is going to be the level where price is going to make a dash for it. So when all those conditions align, I'm taking a controlled shot, often with always with an out-of-the-money fly placed where the move is likely to stall. So in this case, I know price is going to potentially stall on this line right here, this orange line, because in my previous analysis that has shown to be extremely impactful to price support and resistance in the past. So my butterfly is well placed there, thinking that, okay, it's going to hang out here and then potentially break up again into it. Now, it didn't break up until after the market closed, but that's okay. This is still a very profitable trade, because if we're looking at this and looking at the butterfly in profile, let's see if we can get a picture of one here. So when we're looking at these butterflies in profile, the profit line is out here. So when we come near it, as soon as we come near it, we're already in profit. Now this is very late in the day, so that's why it has advanced decay. But earlier in the day, this purple line will be way out here somewhere. So early in the day, when we get close to that fly, that represents a really big profit. As you can see, if that profile line was like right about here, you can look it over here as an example. If I were this close and up here, I have somewhere between a $500 and $1,000 profit already on a trade like that. And you note that our risk is very, very small here compared to the size of the node. Or, I'm sorry, the size of the butterfly. All right, let's go back to the chart. Or we'll go back to the big head. First, we'll go back to the chart. So that's the first thing we're looking for, is volatility. Now, our setup is kind of multifaceted here. We have to figure out how big of a butterfly that we want. We covered this in a previous show earlier this week, how we use volatility and premium decay to determine how big of a fly that we want. So if there's a lot of volatility, we go for a slightly narrower fly, maybe a 30 wide. If there's a lot of volatility, we'll go to a much wider fly, like a 50 wide. And so that is determined. We also determine which direction we're going to go, or we decide that on the fly depending on what happens right at the open, or if we're in a situation where we could be breaking out or finding support. And then we wait for that event, we call it a structural event. In other words, price is going to be moving and it's going to find support or resistance on one of these very strong lines that delineate the bottom or top of a node or one of the deep crevices inside of a well. And so we take the trade, put on the trade, it goes up here, we make big profit. All right. So when do you stand aside and let the first hour reveal its posture before committing capital? On some days, the first hour is all noise. There's no clean reactions, no real commitment from the tape. In those cases, the smartest move is to do nothing. In other words, there are some times when things simply don't set up. And let's see if we can find a case with something like that. Maybe not in these past few days. Actually, this past week has been remarkably good. So it's going to be hard to find a day where things didn't necessarily set up. I would say that this is probably one of those days here, because right out of the gate, at the open, we're moving up hard and into a structural level. But what we're really hoping for is for it to pull back maybe to this line or this line here and then continue up. But it really doesn't. It moves up and then grinds to a high by the end of the day. So we never really got a chance to commit to a trade, right? So like I said, in these cases, the smartest move is to do nothing. Unless, you had the forethought to put on a trade maybe a day before or 2 days before, which is also part of our strategy. But we're not talking about that right now. We're talking about what to do on that day. So in this day, I'm looking at this kind of trade and I'm saying, I don't see any real conviction. The volatility is low. We're blasting off out of the gate and we're moving up into the nether regions. There's no real conviction. So we just let it go. It's, waiting allows the market to declare its posture. A continuation, which is what we got, or a reversal, while keeping you out of low odds trades that bleed theta without giving you any real edge. So if we got into this trade, where do we get in? Do we look at this and say, I'm going to pretend that this is a pullback and get in here? And then the market never really moves anywhere, and you're sitting up here with a fly that never really produces. So that's why we're waiting for that hard pull or push into an edge so that we can gain an advantage. So hopefully this all makes sense. And now I'll bring on the big head, and I'm going to go into some other things for consideration. Let's see if we have any questions. Oh, we got lots of questions. Do you ever take a trade pre-market, pre-report release to catch volatility? Yeah, absolutely. So we do take trades pre-market, and a lot of times after there's been an economic report. Typically, economic reports are released at 8:30, so that gives us about an hour to see what's going to happen. And the structural levels at that point are just as valid as anything else. Now, some of you will say, well, how do I trade the SPX pre-market? Well, it depends on the platform that you have. With Fidelity, you can do that. With Interactive Broker, you can do that. TradeStation, you can do that. With Thinkorswim right now, I don't believe you can trade the SPX, but you can trade the SPY pre-market. And also same thing with Tastyworks. So it depends on your platform. Or you can use futures, and futures are really open to you 23 hours a day, except for between 5 and 6 o'clock in the afternoon Eastern time, when they shut down and start a new session. So futures are available to you as well. The only problem with futures is that you're going to pay a hefty price for the privilege of using futures in the form of commissions. So each butterfly on a future is going to cost you about $21, where a butterfly on the SPX, which is twice as big as the E-mini S&P futures, will cost you about $9. So effectively, it's about 5 times more expensive to trade butterflies on futures. So you have to keep that in mind. It's not a real big deterrent, because a lot of these flies we're putting on are very big. And, what is $21 when you're going for, $2,500? All right. JC says, I got 2 butterflies open right below the all-time high on SPX, bought one for 65 cents, the other for 35 cents. Hard to tell whether that's expensive or not. Perhaps you could tell me what the width is, but if they're wider flies, then I'd say good on you, right? Brian Murphy, I just got one SPX I bought yesterday afternoon for 55 cents, 30 wide, a call, and price is just outside the tent at 63.95. Is my lower wing, that's his lower wing. Could have taken it off at 10 a.m. for about $4. Maybe should have. Yeah, I'll tell you, Brian, hemming and hawing and hoping that price is going to fly into your tent is extremely tempting, because you're looking at the incredible potential profit. I mean, you have $4 right now, so you're up $345, which is nice. But wouldn't it be nice if you could, get inside the profit tent and potentially make $2,000 or $3,000? So I get it, but quite frankly, we're I don't know what's the right word. We are snipers, as opposed to we're going for the the big game. We're in here to grab the profit when we can. The thing is, it's probably a better move if you had looked at market structure and noticed that it's coming up to a very strong structural edge. It might have made a difference. The other thing is, I think we talked about this earlier. If you had multiple contracts, you could have taken, let's say you had 2 or 3 contracts, you could have taken one of them off. It would have easily have paid for the other 2, and then give the other 2 a little bit of time to see if they'll break through. If they don't within some reasonable amount of time, then take those off as well. All right, back to JC. Wow, nice. Mine is only 10 wide, 0 DTE today. When I try to make them wider, they become more expensive. No, they don't. They only become more expensive because you are not used to pushing them further out of the money. That's the problem. We only trade with much wide. For us, 10 wide is totally useless because it has no optionality. And I'm going to show you that in a second. Right? And I know that that's going to sound surprising to you, but a 10 wide fly has no real edge. And I'll show you why. As a matter of fact, I'm going to show you right now. Let's see if we can find this for you. I did a study a couple of years back that really brings home the point on this. Just got to find it. It's way up here. There it is. All right, now I have to go there. All right. So this study, what I did was I looked at various width flies, and they're all at the money, right? And what I wanted to do is I wanted to check out what's the difference between a 10 or a 15 or a 20 all the way up to a 35 wide fly. How do they differ? in terms of the amount of premium that is decayed at various times of the day. And so I took a measurement at the center strike at various intervals of the day, every half hour, from 9:30, 10, 10:30, all the way up to 3 o'clock. Now look at this. Getting into the 10 wide cost me $1.15, all right? It's pushed out of the money. The value of the center strike did not increase at all until 1 o'clock in the afternoon. Why would I want to spend all that time in a trade that didn't produce any value until 1 o'clock in the afternoon? Now, if I had a 30 wide, it would have already have $220 in the center, and by 1 o'clock, it would have been worth over $600. So you can see that if you're sitting out of the money, which one's going to pay better? By far, it's that 30 wide. It gets optionality sooner and faster and greater. So everything about wide flies is where you want to be in this game. 10 wides, really it isn't until you get to 20 wide that they start showing any real usefulness for our trades. And so if you're putting on trades that are 10 wide and you're worried that a 20 wide or 30 wide is too expensive, that's because you're not thinking optionality and risk to reward and convexity. Convexity says push it out of the money. If you want to know more about that, go down below, click the link on our Fat Tail School community, and you'll learn all about how to trade that convexity. Because when I show you how trading real close to the money is not where the game is, trading way out of the money, super cheap, with very little risk, and going after these very wide flies that have huge optionality is where you're going to make the big money. All right, I'm glad I could show that. Thank you for that comment. And we will go back to the big head, and we'll look at some of these other comments. How did you find that price for the 30 wide? Was it way out of the money? So JC's coming back, and now he's starting to realize, wow, Coach Ernie, he's trading these things that are way out of the money. How could he possibly find a price for a 30 wide that cheap? Well, we find them even cheaper, but that's generally where we want to be. And you might think, that's crazy. Of course you do. But that's why I'm making, 4 or 5 times my risk on every trade, and drawdowns that are only 1%, and Sharpe ratios that are in the stratosphere. All right? And you're not. Which volume profile indicator among the several are you using? I am using Thinkorswim. I'm using TradingView, and I'm using their built-in volume profile. That means you have to have a subscription to use it, and it's their visible range profile. That means that it's going to show the profile for everything that's showing in the window. Yeah, he says paradoxically on TradingView. I'm not sure what that means. Okay. Brian's coming back with more comments. I always buy my next day flies when we're at a low or a high. At the low yesterday afternoon is when you get good prices because it's way out of the money. Yeah, that's a good tactic. I have, of course, we have many different styles of trading 0 DTE, and that's really meant for that day. But you could just as easily play this 1 DTE or 2 DTE. As you go a little further out, the types of considerations you have for the trade are going to change a little bit. But really, for close-up, for 1 or 2 or 3 0 DTE, this methodology is perfectly fine. And yeah, he says, use Ernie's profile setup and try to count Elliott waves to see if I should stay to get in or out. Oh, that's interesting. All I can say is I don't use Elliott wave, but I'd love to see your method. And finally, Brian says, when placing trades, I just make sure I have upside and downside protection or flies set out to make money. Well, I mean, if you're trading with that kind of risk to reward, you really don't have to. If your risk to reward is like 1 to 30, 1 to 40, do you really need protection? No. Your protection is the risk that you're taking. It's defined risk on the trade. And that's really the beauty of trading this way. You never really have to worry about managing risk. The management of your risk is the size of the trade that you take. It's all built in. All right. That's all the questions there for now. So if you're enjoying this content, please hit the like button and take a moment and subscribe so that when the next video comes out, you'll get notified. It'll be in your stream. All right. So it's been the JC and Brian show today. And paradoxically. So those are our 3 big commenters. If there's anybody else there that has a comment, please. I make it a point to try to answer everybody's questions. All right. So other things about the morning session. Our setup, like I said, is super important. We're looking for and setting up our structural map first with volume profile. We're adjusting our flies according to the level of volatility, and that will really tell us how wide they're going to be. We practice extreme convexity, so that means that extreme risk to reward. That means we push them way, way out. Now, when we push them way out, sometimes we push them out so far and they're so cheap that we can afford to put one above and below the market. Then we don't have to worry as much about direction. And so then we might not use this this other method of waiting for price to hit one level or not. But it's still a good idea. If it moves down into a structural level, then we'll place the put fly. If it starts moving up there, then we'll place the, a call fly, then we'll place the put fly. And so often you can get into 2 trades that both have a good chance of winning. All right, we got another question here. I watched your session yesterday, so I am new to all of this. I took a sim trade in Thinkorswim for an out-of-the-money 30-wide fly, and when it had increased in value, I tried to get out, and it would not fill. Well, that's a sim trade, right? You can't go by a sim trade. In a live trade, it's likely going to fill. A sim trade is an unreliable indicator, but if you could see where you could have gotten out for profit in a live trade, you would have gotten out there. Do not use a sim trade as your judgment on whether you can get in or out of a trade. It's absolutely not an indicator. So I guess I answered your second question. Is that something that can happen live? No, especially with the SPX or the E-mini S&P futures. It's got super liquidity. There's just no way that you're not going to be able to, unless you're sitting there trying to chase price, right? And that could be. And a lot of people do that. They'll see the mid price and they'll put that mid price hoping to get it, and then it starts moving away from them. And so then they'll move back up to the next mid price, wherever it is, hoping to get that, and then it will move away from some more, and then they'll try to move, and they'll just keep on chasing it, and then they'll say, "Well, I couldn't get into the trade." No, you couldn't get into the trade not because of any liquidity issues or because the market was moving too fast. You couldn't get into the trade because you couldn't accept what the market would take as a price to immediately fill. And it's pretty easy. You can, if there's a mid price, just price your limit order to maybe 10 cents more or 15 cents more. And if it's a real fast moving market, make it 25 cents more. That's better than keeping on chasing it and then end up losing 25, 50, $1, $2, or whatever it is. So get ahead of it and make sure you get into the trade. It's pretty simple. A lot of people tell me that they can't get into trades. My only answer to them is that's because you didn't give the price that the market wanted. See, it has nothing to do with the price that you want. And that's a skill. It's a skill of how to enter a trade and get filled quickly by knowing what the market will take and then placing that order. If you think you're going to get filled all the time, now every once in a while when you place the mid price, you have enough volatility that it might fill. It doesn't happen that often. And so that's a skill that you need to develop. All right. I think that's it for questions. All right. I think we can wrap it up here. So first hour, like I said, volatility plays a big role. Market structure plays a role. Our adjusting of our butterfly in that environment makes a big difference. So in other words, the wider the fly, we're going to give us actually a better chance of profiting and being able to effectively navigate that trade. So wider is almost always better. Narrower is just, I don't know, it's being penny wise, pound foolish. I guess that's the term. But that's what, and that's mostly because of a misunderstanding that you think that you have to be closer to the money in order to make money. And that's not the case. In fact, being closer to the money and then paying more for your fly over the long run is the sure way to blow up your account. You're taking on way too much risk for the amount, because the risk that you take is inversely proportional to the profit that is available. So the less risk that you take, the more profit that's available. It also means that you're going to have lower drawdowns and less volatility in your equity curve, and you're going to have much more optionality to play with. So think about that. Good for you, JC. Glad to hear it. JC says he's up $400 now. So that means the market must be moving up. Fantastic. Let's take a look. You have a put fly on. The market's moving down. I should have remembered that. All right. I am done. I want to thank everybody for showing up here. Again, go down below if you want to join our Fat Tail school community, where you'll learn all about options, trading options, convexity, and using super low risk for high return with very little volatility and very little drawdown. All right. Thank you very much. Take care, y'all. Have a good one. Coach Ernie, out. Oh. I hit the wrong button. There we go.